Two savers, same age, same $100,000 in the bank, same 10 years of disciplined saving. One ends with about $122,000 of real purchasing power. The other ends with around $78,000. The difference isn't how much they earned or how much they saved, it's whether they understand a quiet tax that strips wealth from anyone holding cash. I'm a finance professor and I teach this to my students all the time. This tax has a name. It's called financial repression. The US used it from 1946 to 1974 to cut government debt almost in half. And a former Federal Reserve chair just said in January of this year that the next Fed will be tempted to use that same playbook again. Today I'm going to walk you through three very important things. What financial repression actually is, the three forms it takes inside your portfolio right now, and the three-move defense I teach my students to keep your real wealth growing while everyone else's is bleeding. Let's get into it. My name's Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. Remember that all investing carries risks, so do your own research. This is not financial advice, and I'm not a financial advisor. Financial repression is a term coined by economists Carmen Reinhart and Belén Brancia in a 2011 paper called The Liquidation of Government Debt. The idea is simple. When a government is buried in debt, it has three options: default, cut spending, or grow their way out. All of these are politically painful, but actually there's a fourth, and this is the quiet one. This would be to hold interest rates below inflation for years and force domestic savers to fund the government at a real loss. Debt shrinks relative to the economy, savers absorb the cost, no vote required. Reinhart and Brancia found something very specific. From the end of World War II through mid-1970s, the United States used financial repression to drop public debt to GDP from roughly 106% to around 24%, almost a two-thirds reduction in 3 decades. The mechanism? Real interest rates were negative roughly half the time across that window. Their estimate: the annual debt liquidation rate for the US and UK averaged 3 to 4% of GDP per year. And almost nobody tells you about this part. That liquidation doesn't just come out of thin air. Someone pays it, and that someone is whoever's holding cash, or a CD, or a bond. Let me show you the real numbers. A saver in 1946 with $100,000 under the mattress would have about $39,500 of real purchasing power by 1974. 60% of their savings gone. Same saver rolling $100,000 in 3-month T-bills the entire time. They end with about $83,000 real. 16% real loss over 28 years. They earned the going safe rate, inflation still ate them alive. Now the same saver in the S&P 500 with dividends reinvested. They end with about $520,000 real. 5 times the starting purchasing power. Same dollars, same 3 decades, different vehicle. That's the quiet tax in one chart. Hold cash, get liquidated. Hold real assets, get protected. Now, if that didn't already get your attention, this definitely should. In January of this year, Janet Yellen, the former Fed chair, gave a speech at the American Economic Association meetings. She used the phrase financial repression twice. Quote, fiscal dominance is also likely to raise term premia and borrowing costs as investors become concerned that the government will rely on inflation or financial repression to manage its debt, end quote. Look, here's the thing. The current national debt is almost $39 trillion. Public debt to GDP is around 100%, almost exactly the level we sat at in 1946. Same math, same pressure. Now we have a former Fed chair publicly warning the same tools are on the table again. So let me show you all the different forms of financial repression that we're seeing right now and that we're going to see so that you can prepare. Form 1 of financial repression, rate suppression. Basically a real yield bleed. Watch the gap between the rate your savings earns and the rate at which prices are rising. When that gap turns negative, repression is live. And right now, the Federal Reserve is holding the Fed funds rate between 3.5% and 3.75%. The most recent CPI print is 3.8% year over year. So the Fed's policy rate is already negative in real terms. Inflation is higher. 2 months ago, inflation was under by over 1 full percent. The cushion is collapsing. And remember, the Fed's policy rate is not what the bank actually pays you. That's what the Fed pays banks. The FDIC's national average rate on a regular savings account in May 2026 is about 0.45% annual percentage yield, 45 basis points, against 3.8% inflation. That's a real yield of negative 2.4%. Now, some of you are thinking, Professor G, I've been listening to you, and so I've put most of my money in a high yield savings account or money market account. Now I'm getting something like 3.3%, 3.5%. And that's great. That's way better than a regular savings account. But at the best case, your real yield is exactly even at zero. Most of you are probably losing money still to inflation right now. Let me show you the dollar math at 3 different saving sizes. Scenario 1, national average 0.45% APY. CPI is at just 3.3 for 5 years. A $100,000 saver loses about $13,700 in real purchasing power. $250,000 saver loses about $34,000. A $500,000 saver loses about $68,000 just for sitting still. Scenario 2, this is a top tier high yield savings account. We'll say it's between 3.2 and 3.5%, but even here, they're just staying about even and probably losing just a little bit each year. The difference is that on $250,000, if your money's at a regular bank, you lost $34,000. At a high yield savings account, maybe it was just an absolute zero. That's a big difference. They're both not great, so I don't love it, but huge difference. The trap, most savers are not picking the best case scenario. Most people are still in a regular bank account, a regular savings account, and that's real yield bleed. I'd say if you have more than 2 or 3 months worth of living expenses in just a regular bank account, I personally would be getting that out and be putting it into a high yield savings account at the very least. All right, now form 2, and this one's called the pension tilt. This is the form of repression that most people don't actually see because it's not in your bank account. It happens inside your retirement account when you're not really looking at it. Regulatory frameworks tilt large pools of capital, banks, pension funds, insurance companies, target date retirement funds toward holding low yield treasury securities, whether those securities are good investments at current prices or not. This isn't conspiracy, this is regulation. Banks have to hold treasuries to meet capital requirements. Pension funds are required by law to hold safe funds or safe funds. Target date funds slide you into those bonds automatically as you age. The entire system is plumbed to absorb government debt at whatever yield the treasury offers. So here's what the tilt looks like in your own accounts. If you have a 401k, there's a high probability your default investment is a target date retirement fund. Vanguard Target Retirement, Fidelity Freedom Funds, T. Rowe Price Retirement. These funds glide your allocation from stock heavy in your 20s to bond heavy in your 60s. By age 65, a typical target date fund holds 40 to 60% in bonds, mostly intermediate and long duration treasuries. In a normal rate environment, that's fine. Bonds are supposed to be your stable counterweight. In a financial repression environment, where the Fed holds the long end below inflation, those bonds are not stable. They're quietly losing real value inside your retirement account every year. Right now, the 10-year Treasury yield is around 4.4%. The 30-year is just under 5%. CPI is 3.8%. So the real yield on a 10-year Treasury today is less than 1%. The real yield on a 30-year is closer to 1. If inflation drifts higher, those numbers turn against you, and you don't see it because your target date fund's automatically buying more bonds every year as you age. Most investors that I talk to in my private coaching have no idea what they're actually invested in within their 401k or within those target date funds. They picked it once and they forgot. Meanwhile, the fund is quietly buying long duration treasuries on autopilot in an environment where long duration treasuries are exactly the wrong thing to hold. And here's a quick dollar example. A 401k holder with $100,000 in a typical 65-year-old target date fund earns about $7,000 real dollars on the bond half over 5 years if current rates and inflation hold. If inflation drifts to 4% and the Fed does not respond, that real return turns negative. The same bond slug loses $1,000 to $2,000 real dollars per year. Same fund, same allocation, different outcome. Multiply accordingly at $250,000 and $500,000 balances. But the defense is not to totally abandon the target date fund. The defense is to understand what's in it and then to add positions that are going to protect that bond half. Let's move to of the defense that's coming up. But first, let me show you the last portion, number 3, which is called the tolerance drift. The Fed has an official target of about 2% for inflation. They haven't hit it consistently since like 2021, and since then it's been between 3 and 9%. Right now we're at 3.8%. And here's the question, what if the Fed stops fighting to try to get back to 2? What if they decide right now this is good enough because cutting any harder might not be good for the economy? That's called the tolerance drift. And this one's the toughest to do anything about because it doesn't require any explicit policy change. It just kind of means that the Fed just decides not to do anything. In 2002, Ben Bernanke gave a speech titled Deflation, making sure it doesn't happen here. He laid out the Fed's tools to prevent deflation. Quote, the US government has a technology called a printing press that allows it to produce as many US dollars as it wishes at essentially no cost. Basically, the Fed has unlimited ability to fight deflation, very limited will to fight inflation. When fighting it costs the Treasury hundreds of billions in interest expense. At the end of the day, the political pressure to keep rates where they are, specifically because it gets expensive, is absolutely enormous. And for the most part, they're thinking of things that are not necessarily our best interest at mind. So what do we need to do? Here's the 3-move defense. Each one neutralizes one form of repression. Move 1 is the real asset anchor. Before you do anything else in your portfolio, you need to make sure and have and invest in assets that are actually going to move with inflation. If inflation goes up, that shouldn't be the end of the world because your portfolio should have real assets that move up with inflation. That would be real estate, stocks and ETFs, productive assets that earn real return through inflation, not despite it. VOO for the S&P 500, VTI for the total market, SCHD for dividend growth, VYM for broader dividend exposure, QQQM for technology and broad growth, real estate through REITs or directly. The exact mix depends on your situation and your risk capacity. Let's move on to move number 2, and this one's called a tips ladder, and I haven't talked too much about that on this channel, but I do talk about that with my one-on-one clients if it makes sense in their situation. Treasury inflation protected securities. US Treasury bonds whose principal adjusts upward with inflation. When CPI rises, principal rises. Real return contractually guaranteed. Right now, the 5-year TIPS real yield is around 1.4%. The 10 years around 2%. Those are real yields after inflation, locked in by the US Treasury. Wade Pfau has written a risk-free way to support 30 years of real income. At recent TIPS rates, that ladder supports a safe withdrawal of about 3.74%. A $100,000 TIPS ladder, average real yield 1.7 cross rungs, generates about $18,500 real over 10 years. $250,000 ladder generates about $46,000. $500,000 ladder generates you about $92,000. All real, all Treasury guaranteed, and no equity risk. That's the floor under the rest of the portfolio. And this isn't necessarily something that everyone needs to do, but for those that are very conservative and also that those just want to be very, very safe, this is one of the only ways that you're going to get that guaranteed inflation protected. And let's move on to number 3. And this is one that I do talk about very often on this channel, and this is dividend compounding. My favorite is dividend growth ETFs as the foundation. SCHD, VYM, those are my favorites. Companies that consistently are adding or increasing their dividend have real pricing power. They pass inflation to the customer, and their dividend grows at or above inflation. So reinvestment compounds that growth in any inflationary environment. SCHD's trailing 5-year dividend CAGR is about 11.6%. Current yield about 3.3%. Compare that to the FDIC national average of 0.45%. Same dollar park, different real outcome. A $100,000 position in SCHD with full dividend reinvestment projecting trailing 5-year nominal total return of 9.2% ends in 10 years at about $240,000. After 3% inflation, real terminal value about $175,000. Real gain is about $75,000. Compare that to the FDIC national average saver who loses 13,700 real dollars over the same 10 years. Same start, but difference of nearly 90,000 real dollars. So let's go back to those two savers from the beginning of this video. Saver A, $100,000 in May 2026, held in a regular savings account at one of the big four banks, 0.45% APY. Let's hope inflation dies down a bit from 3.8 to 3.3. CPI runs at 3.3% for 10 years. After 10 years, Saver A's nominal balance is about $104,600. In real 2026 purchasing power, that's about $77,700. They lost more than $22,000 of real wealth by doing nothing wrong, just by being a normal saver. But let's look at Saver B, same $100,000. They run the three-move defense, 60% in SCHD and VYM dividend growth, which is the anchor, 25% in 5 to 10 year TIPS ladder, which is the floor, 15% in a top-tier high-yield savings account for liquidity, and that's their cushion. After 10 years, assuming the dividend ETFs deliver something close to their trailing 5-year real returns, TIPS deliver their stated real yield, and the cushion earns positive real yield, Saver B's real terminal value is around $122,000. Real gain of about $22,000. Same starting balance. The gap is about $44,000 real in either direction on $100,000 over a single decade. Now do the math if you have much more than $100,000. If you're at 10 times that or 20 times that, that's how much you could be losing in real dollars. And that is the quiet tax. And now if you're far from retirement, like very far, 10 years or more away, there's definitely much better places for your money to go into. This was more of the safest and probably more for people who are right near retirement or in retirement. So if you're a little bit further away from retirement and want to keep your portfolio growing like crazy, this video here is the most simple ETF portfolio that's going to keep you way above inflation, probably 3 times inflation for the most part. And it's going to be very, very simple, very solid. And I even give you the exact percentage breakdown for each asset class within your portfolio based on your age. Watch that one or this one to keep you going strong in investing. And remember to keep investing simplified.